whenever there's sort of a macroeconomic shock and then venture capitalists change their behavior, there's an immediate critique, which is like, well, why on earth would VCs change their behavior, right, in response to a stock market change? Like VCs are investing in a company today with the idea that it might go public, but sometime between, 5 to 10 years in the future. What possible relevance could it have on what happens 5 or 10 years from now? And so shouldn't basically VCs just keep doing the same thing? And I think the thing that's important to understand, consistent with what our other guests have been talking about, is basically, the whole investment landscape is a food chain, right? And so when a venture capital firm invests in a Series A, what's the big risk to the VC that invests in the Series A is that the company won't be able to raise a Series B, right? What's the big risk of investing in a Series B? It's that the company won't be able to raise a Series C. What's the big risk for Series C? It's that the company won't be able to raise a D, and so forth and so on. And then ultimately, maybe the company can't go public. There is this thing where you have to have some sense that the investments you're making now are going to be actually viable in whatever the unfolding, kind of economic environment is, and specifically that they're going to be able to raise a next round.